Good afternoon, everybody. Uneducated economist here. So we have another sell-off in the Dow today. Like I said before in previous videos, we got a two-step back, one-step forward kind of approach happening here to the markets. One of the things that we are seeing is a lot of talk and not a lot of action. Now, there is action as far as the government goes with the declaring of emergencies, and like just before I started the video, we had Washington State ban all large events. I'm not sure exactly what that means or how big the events are. I haven't gone and researched that part of it. But a lot of what's taken place inside of the markets is a lot of talk from the administration, from the Federal Reserve, from, different angles. That is part of the approach that Ben Bernanke had put into a speech many years ago. See, they knew that they were going to run into the lower bound of zero. They knew it. They knew that at that point, the Federal Reserve would have very little room to fire off a stimulus package. See, typically the Federal Reserve would try and drop interest rates around 5% in order to get the economy moving again. They would want people to go out there and take out loans, buy cars, buy houses, go out to eat. That approach will not work. They can't do it any longer. Okay? But Ben Bernanke said in this speech, and it was probably 10 years ago or so, this speech came out. And I'll try and find it and I'll leave a link down in the description for you guys. And those of you who follow my channel, you've probably heard me talk about this quite a bit. We used to talk about the credible threats. And that's what Ben Bernanke was referring to, was credible threats in the way to deal with the market. And the way he told it was with a little story about a guy who invented a gold machine. And if you can imagine a guy who invented a gold machine and it was legitimate, like he has the machine, he has the patent, he has the proof, everybody knows that this gold machine exists. And he could produce as much gold at very little cost. Once that information gets out to the markets, what would happen to the price of gold? It would plummet. Before the guy even produced a single ounce of gold, just the credible threat alone would be enough to move the markets. And that's what's taking place now. We saw it yesterday when the administration came out and said that they plan on cutting payroll taxes to zero. That information got the markets excited and the markets rose incredibly high. Today, that information no longer works. See, it's a new day. And the World Health Organization came out and declared a pandemic. Italy is locked up. They had an interesting play. They said that they are going to suspend bills, taxes, and mortgages in that country. Isn't that an interesting one? But going back to these credible threats, even if the Federal Reserve was to come out and say, hey, we're going to drop interest rates again, how much room do they have? Very little. Even if they were to drop a 0.5 percentage point, it would not make a difference. The ECB came out, the European Central Bank, they dropped interest rates 0.5%. And the markets don't care. See, no matter what the officials out there are going to do, it doesn't make any difference. You can no longer paper over this problem. It will not happen. The only thing that they have is their credible threats. It's the only thing they got. Other than that, they can print up a bunch of paper, they can go out there and buy a bunch of debt, but does that produce anything? Does that make food come to the table? Does that make production take place? How much credible threats out there before the people just stop listening? See, that's what I wonder about, like, when I hear people talk about modern monetary theory. That was another, suggestion. They just print up a bunch of money and just send it to us. Just checks in the mail or whatever. Just inject it right into our bank accounts or maybe through payroll. Is that going to make any difference? Could for a little bit. But then what happens at the end of the road? You come to that wall again. And attempt to kick the can, you can't kick it much farther. See, I don't know. Like, if people ask me, what's it going to be like in 2 months? I couldn't tell you. I don't know what the Federal Reserve has planned. I don't know what the administration has planned. I don't know how bad people are going to react to this pandemic that's taken place. I know the markets hate it. And at the same time we're seeing a sell-off, we're starting to see interest rates rise on the treasuries. Think about that for a little bit. The 10-year treasury was at like 0.3 something percent just a few days ago. And now it's at 0.75. The yield on the 10-year treasury has risen. That's the benchmark for mortgages. That's the benchmark for all interest rates. Credit cards, car loans, mortgages. Look at that 10-year. It's starting to rise. Will it continue? I don't know. But it is right now. People are getting out of the treasuries. They don't see it as a safe haven. You know, Peter Schiff had tweeted out not too long ago saying that the Federal Reserve was able to get the attention of the people by convincing them that they were going to normalize their balance sheet. They didn't. They failed miserably. They didn't even come close to normalizing their balance sheet. Now you think about this, prior to the financial crisis, there was around $850 billion in circulation, and now we have close to $4 trillion. What is it that the Federal Reserve is going to do to try and stimulate the economy? Go into massive quantitative easing, where they are going to print up even more money, more than they've ever printed before, and then some, an attempt to buy the treasuries, the mortgage-backed securities, everything that's turning into a toxic asset, they're going to try and buy. And people are recognizing that as being the problem. You're starting to see it happen in the junk bond market. Those high-yielding corporate debts, the people who have been giving the zombie companies money, wanting that interest rate, wanting that higher yield from those companies, are now recognizing that that's a problem. And they're getting out of that trade. People no longer want that paper promise. And you can really see it taking place now in the markets. See, typically when up until just recently, you would see a teeter-totter in the bond market and in the stock market. Where if the stock market went down, the bond market went up. And if the bond market went down, the stock market went up. But now what are you seeing? The stock market is going down, and the yield on the treasuries are going up. That means that the bond market is not doing so well. See, when yields on interest rates start to rise, that's because the investors are demanding more rates. They want a higher interest rate before they buy it. That's the reason why the Federal Reserve has to step in. If those interest rates rise and we start having higher and higher yields on the bonds, that is going to make it very difficult for companies and anybody else out there who is highly leveraged to make their payments. And the higher the yield goes, the worse off it gets. And we said it. We said it in these videos time and again, that if interest rates rise on these bonds, there's going to be a sell-off in the market. Who owns the shares? Companies have borrowed money and bought back their own stock. They're going to have to sell that stock in order to pay the bondholders. You know, it's happening all over the world here. I saw Ecuador is now up to 20% on their interest rates. 20%. Can you imagine if the U.S. was even remotely close to that? There was a time, way back in the early 80s, where they were paying an incredibly high interest rate. People had house loans for 20%. You know, never in my life have I ever been so confident in purchasing precious metals than I am right now, especially silver. I'm not saying that it wouldn't go down. I'm not saying that to you guys. Silver could very well go down, but the downward potential of silver compared to the stock market or compared to the bond market is incredibly small in comparison. You know, real estate has had a boom for a long time. Every year, if you were going on average, you would see real estate moving up every single year, except for a few. But on average, it was a continuous rise. And in conjunction with that, interest rates have fallen every year for 40 years. Interest rates hit zero, and what's the point anymore? Why would you loan money out for zero interest rate? Who's going to buy that other than the Federal Reserve printing up money and buying zero interest rate bonds? We're in a dangerous situation, guys. Very dangerous. And to think that this can be just fixed in a week ain't going to happen. Especially like countries like Italy. If they are the test subject for what could happen for the rest of the world, where they lock down, tell the people you don't have to pay your bills or taxes or mortgages, how well is that going to work out? How much damage is that going to do, and how long will it take to repair? Think about that. You know, I saw where Boeing has announced that they're not going to have any more hires for a while. Why? Because nobody's flying. You don't need planes if you're not flying. If the travelers are not traveling, if people are not going out to restaurants, if people are not spending their money on the things that they had before, we are going to have a very different situation take place in this country. You know, I thought about the payroll tax cut that the administration came out with yesterday, saying that they would cut payroll taxes to zero, maybe even permanently. Really, how do you fund government after that? Do you just continue to deficit spend? Imagine yourself no longer taking an income, and instead, you're just going to use a credit card from now on. How long would it last before your creditor, the people who are loaning you the money, giving you the credit card, say no more, we're not doing it? How beneficial is it going to be to you if you were to pay off your old credit cards with new credit cards? Scratching to find somebody to loan you money, to give you another credit card so you can pay off the old credit card and keep your lifestyle going. How long could that last? Because that's what they're suggesting, is something not too far off from that. When that system crashes, it's going to be what you have in possession. The paper promises, the third party out there who says, hey, here's your envelope that says this is how much money you have in there. What difference is it going to make at that point? What are you going to do? Are you going to go to those companies and say, hey, you owe me? You know, I see where these apps where you can buy stocks are locking up. What if you can't log in? What if you can't call somebody and say, hey, where's my money? What are you going to do? What if you can't get that credit card? See, having something in hand, something that is tangible, something that is desired, something that is needed, that's going to be the important thing. You can't fix this in a week. I don't care what they do. If it all went away tomorrow, the damage that has taken place right now is going to take months to repair. Papering over the problem is not the answer. Going deeper in the debt is not the answer. I couldn't tell you exactly what the answer is, but that's not it. Somehow we have to figure out to be producers again and start paying off them debts. And start again. And it's going to come down to what you have in your house. What you have in the safe. The paper promises, they're not going to make any difference. Exeter's pyramid, that is in play right now. The things that go from the most liquid to the least liquid. And the least liquid things out there are those paper promises, the derivatives, the insurance policies. There's a great video that Chris Dwayne talked about, Exeter's pyramid. I'll see if I can find it and leave a link for you guys. It is excellent, excellent stuff. It's about a half an hour long, but it is well worth watching. uneducated economist. You guys let me know.